When you look at a candlestick, it's easy to focus on the body, the open and the close. But the wicks, also called shadows, are often where the real secrets live. Wicks show the extremes of price. They reveal the emotional highs and lows of the session, the attempts, the failure, the battles that almost happened but didn't last. The wick at the top of a candle shows how high buyers tried to push price before sellers push it back down. The wick at the bottom shows how low sellers pushed price before buyers stepped in and bought it back up. In other words, the body shows what happened. The wicks show what almost happened. Here's an easy real-life analogy. Imagine you're trying to push open a heavy door. You push in halfway open, but it slams back. The furthest point you reached before losing control is the wick. The final position of the door is the body. Wicks are the market's almost. Long wicks reveal rejection. A long upper wick means buyers failed to stay in control. A long lower wick means seller failed to sustain the move. These rejections are incredibly powerful clues because they show where the market reached its limits and got pulled back. But wicks do something even more powerful. They expose liquidity. Above every major high, there are stop losses from sellers. Below every major low are stop losses from buyers. Institutions target these levels. They push price up and down just far enough to grab the liquidity and then reverse the market. This manipulation shows up as wicks. In smart money concepts, wicks are like fingerprints. A wick above a level without a body break often means a liquidity sweep. A wick below a level without a breaking structure often signals accumulation. Wicks reveal intent when the candle body can't. Now let's talk about patterns built from wicks. A hammer is defined by a long lower wick with a small body near the top. That wick shows heavy rejection. Buyers stepping in aggressively. A shooting star is the opposite. Long upper wick with small body near the bottom. Sellers took control after buyers failed. A pin bar uses wick dominance to identify reversals. In trends, wicks show exhaustion. In an uptrend, long upper wicks near resistance can signal that buyers are running out of strength. In a downtrend, long lower wicks at support can reveal sellers' exhaustion. Wicks also help you read volatility. A candle with small body and very long wicks shows a market full of uncertainty, indecision, and mixed sentiment. This is often what happens before major news or right after it. But one of the most overlooked strengths of wicks is how they reveal failed moves. A breakout attempt with a wick above resistance that closes back inside the range is a failed breakout. A breakdown with a wick below support that closes above is a failed breakdown. These failed moves often lead to powerful reversals. Let's make this ultra simple with a story. Imagine a crowd trying to push a heavy box up a ramp. They push hard, really hard, and they almost get it to the top. But then they lose strength and the box slides back down. That point where the box reached its highest but couldn't stay, that's the wick. It's a market showing its limit. And traders who know how to read wicks know exactly where the pressure fell. Even inside intraday trading, wicks tell you where liquidity was taken. Price sweeps a level, forms a wick, then moves in the opposite direction. That one wick becomes a clue to the true direction of the session. So to summarize, wicks shows how far price attempted to move. Upper wicks show rejection from sellers. Lower wicks show rejection from buyers. Long wicks identify liquidity grabs, traps, and exhaustion. Wicks define key reversal patterns. And in smart money concepts, wicks are essential for understanding manipulation, intent, and true direction. But more than anything, wicks are emotion, they are aggression, they are hesitation, they are a struggle between buyers and sellers in the rawest form. Learn to read wicks and you are not just reading price, you are reading pressure.